We're going to talk about the Hikite or snapback effect, so let's get into it. The Hikite or snapback effect is not really an AP macroeconomics term. It's my term for associating it with something that I know, which is the snapback of a karate or gyakuzuki punch in Shotokan karate. The little stick figure down at the bottom illustrates what we're talking about. To punch out requires an equal and opposite counteraction of the pullback hand to get, imagine throwing a rock or something. If you use just one arm, that is a certain amount of power. But if you instinctively or just reflexively throw your other arm back the opposite way, you can really get some more force generated with that. So, and that parallels something in the macroeconomy that I think about and that we should be familiar with, and that's the tendency for the economy to move toward full employment, even without government policy. There is a tendency to move towards that full employment output. So the Hikite or snapback effect is the economy, the reality that the economy has a tendency to move toward full employment. It snaps back to Y sub F or full employment. And you can think about maybe this expressed in a bumper sticker. The classical economic understanding of how an economy works is that markets equilibrate. Supply, quantity demanded and quantity supplied applies not only in one market, but in all markets. There's a general tendency to equilibrate. And as we'll see later, Keynesians say not necessarily. Okay, so let's say that there's an inflationary gap that opens up. And so we have our two markets here, two of the four macro market models that we should know about. Goods and services on the left, the goods and services market, or the ADAS model. And on the right, resource markets. The ones that are not shown, of course, are loanable funds and exchange rate markets. We won't need those for our purposes today. One other thing that I would like to emphasize here is the position of the short-run aggregate supply curve is based on a set of constant or unmoving resource and input prices, especially wages, which are a large part, as we know from looking at GDP chapters, a very large part, perhaps 70% of compensation. So just keep in mind, we draw that short-run aggregate supply curve in the position that we draw it based on existing input prices. If those input prices, especially wages, change, then we can change the position of that short-run aggregate supply curve. So that's an important thing to keep in mind. Okay, let's assume that we have an inflationary gap. Now, what would cause that? Well, let's say a stock market boom where the wealth effect is such that people feel wealthier and go out and spend more. Their consumption goes up. Consumption, as we know, is a big component of the expenditures approach of calculating GDP. And so it's reasonable if consumption goes up at all possible price levels, aggregate demand will go up too. That we know, we can see from our ADAS model, will open up a higher price level and temporarily a greater than full employment output level. We'll just call it Y1 or Y prime. Now, what happens in the goods market is this inflationary gap and a temporary increase beyond full capacity of the economy. Now, how could that happen? Well, we could visualize or imagine third shifts. We could imagine wage rates rising and attracting new entrants into the job market. Because the opportunity cost, let's say, of staying on the couch is getting a little high. So wages are becoming attractive during this inflationary gap. Now, we know down here that profits, we know this from microeconomics, that profits are the difference between revenues coming in and costs going out. And during that recessionary gap in the early phases, businesses notice, wow, our revenues are going up, our prices are going up. And let's assume that the wage contracts haven't caught up with that. So the cost of living is going up, but then workers catch on and they start to ask for higher wages. Okay. So let's say that the business costs go up at a faster rate than resources, and now profits are starting to get squeezed a little bit. Over here in the resource market, let's depict what's going on. Because there's an increased demand for workers, because workers are in short supply during this temporary gap, we've got an increase in the demand for labor. That puts upward pressure on wages. Now, we said before that upward pressure on wages is going to have an impact on the position of the short-run aggregate supply curve. So we'll take a look at that. But know that in the resource market, especially the labor market, wages are going up. There's upward pressure. As that occurs, we get a shift in the position of that short-run aggregate supply curve, okay, to SRAS sub 2. So the snapback effect, or the Hikite effect, is we get that temporary increase in real output at a higher price level, but then it snaps back to full employment. How come? Well, because here's that new equilibrium, E2 we'll call it, capital E2. Why? Because wage rates went up because of the competitive bidding in the labor markets, and so the position of that short-run aggregate supply curve moved. So the path of the economy is the inflationary gap opened up because, again, of that increase in aggregate demand. We had a temporary increase in output at a higher price level. But then as profits got squeezed by that rapidly increasing wage rates and workers starting to renegotiate their labor contracts, then their profits were squeezed and the short-run aggregate supply curve shifted to the left. So that's how there's a natural tendency in the economy, even if there was no government intervention, to move toward full employment given a recessionary gap. An inflationary gap. But how about the case of a recessionary gap? Again, for emphasis, the position of the short-run aggregate supply curve is predicated on the idea that we have a certain level of input prices, especially wages. So we start out at equilibrium. And then let's say that a recessionary gap opens up. Let's say pessimism grips the land. Businesses are afraid to invest, and so they stop investing. So there's a decrease in aggregate demand, shown as a shift from 81 to 82. Now we've got a temporary recessionary gap opening up, a lower price level, and a less than full employment a real output level. Okay, so we would anticipate seeing rises or increases in the unemployment level. Now, if that's the case, how would that affect the demand and supply for workers? Well, if profit margins are getting squeezed down here again because revenues are falling during the recession, chances are good that all demands for all kinds of, including the demand for workers, would probably be going down. And that would exert downward pressure on wages as well. As wages fall, assuming again that they are flexible in a downward position, and we'll see more about that assumption, which is a key contention between Keynesians and non-Keynesians, that will affect the position of the short-run aggregate supply curve. If wages are going down, then we can draw a new short-run aggregate supply curve that reflects those lower wage bills and wage costs. Okay, so now the path of the economy is we've got this recessionary gap opening up because of pessimism in the land and a decrease in aggregate demand. But as wages fall, we've got a new equilibrium, we'll call it E2 again, that snaps back to the economy's long-run output capability. So there's an increase. Costs fell, let's say, faster than revenues did, and profits were squeezed, such that we've got a new position of the short-run aggregate supply curve. and it goes back to full employment. What about unanticipated supply shocks? Let me just fix that quickly. In this case, we can see that we might get a temporary increase, let's say because of a great bumper crop in the nation's agricultural output. And so we might get a temporary increase. And we could also anticipate a negative supply shock, let's say a dramatic increase in the cost of energy, let's say. And so we could draw a short-run aggregate supply curve either to the left, reflecting a decrease, or to the right of the existing or the previous or the original short-run aggregate supply curve. So in this case, we'd get a temporary increase beyond full employment output, and in this case, we would get a kind of a recessionary gap. Actually, it's a stagflationary gap because price level would be going up while unemployment would be going up at the same time. Now, what happens in the long run depends on whether there is these changes, the increase or decrease in short-run aggregate supply, are permanent or temporary. If, let's say, the increase in short-run aggregate supply is temporary, then there is no effect on the long-run output capability of the economy. So the position of the long-run aggregate supply curve remains the same. And then because of adjustments in resource prices and so on and wage negotiations, we snap back to full employment. Okay, Hikite effect. Let's say, though, that in the case of the inflationary gap, that there is that's a permanent effect. Let's say the cost of energy is permanently higher for whatever reason. Now we get a shift, and it affects it's long enough and permanent enough to affect the output capability of the economy as a whole. So now we shift or contract the long-run aggregate supply curve, showing that there's actually been a diminishment in the output capability of the economy. So now here comes the new equilibrium at a higher price level, but at a smaller output capability. And that's long-run equilibrium, the intersection of the new position of the long-run aggregate supply curve, that short-run aggregate supply sub 3, and aggregate demand, which hasn't shifted. And that is the Hikite or snapback effect.